In this overview, we walk through VALIDEA'S implementation of the Protective Asset Allocation investment model. This is a model that combines relative and absolute momentum to invest in the best performing asset classes, but it also has the ability to shift to a crash protection stance when momentum breaks down. The insight investors may want to consider when looking at the model is this. Investors looking for additional diversification and protection from major market declines relative to something like a traditional 60-40 portfolio might want to consider expanding their horizons beyond just stocks and bonds and utilizing trend and momentum. The strategy invests in the asset classes with the highest momentum using a diverse group of 12 different asset classes. It invests in the 6 asset classes with the highest or most momentum and will move aggressively to a crash protection stance when the assets in the selection universe enter a downtrend. As for the source and the evidence behind the strategy, we based the model on the paper Protective Asset Allocation, a simple momentum-based alternative for term deposits. The authors tested the strategy between 1970 and 2015, and based on their research and testing, the Protective Asset Allocation model showed better raw and risk-adjusted returns versus the overall market and the 60-40 portfolio. The investment thesis behind the model is this. Absolute and relative momentum can help investors boost returns and help protect from major declines when compared to static asset allocation approaches. Now let's take a look at how we would build the Protective Asset Allocation model in some detail. The first thing we need to do is to determine the selection universe. Here, the model has the ability to select among 12 different asset classes. Those asset classes include the S&P 500, Russell 2000, NASDAQ 100, European equities, Japanese equities, emerging market stocks, long-term treasury bonds, high-yield bonds, corporate bonds, commodities, gold, and real estate. From there, we need to determine the 6 top-performing asset classes based on momentum. So the model uses the 12-month look-back momentum and selects the 6 asset classes that have done best over the past 12 months. The portfolio is rebalanced monthly, so each month, the asset classes are reviewed and ranked by their momentum, and the top momentum performing asset classes are held in the portfolio at equal weight. Lastly, there's a crash protection overlay incorporated into the portfolio. This has the ability to move in and out of these asset classes and raise cash as the momentum deteriorates. Once 6 or more of the asset classes out of the 12 in the selection universe have negative momentum, the portfolio can move to a 100% crash protection position. Investors looking for an alternative to a 60-40 portfolio that want to utilize momentum in their investment process and see the value of raising cash to protect to the downside may want to consider the Protective Asset Allocation strategy for part of their investment portfolio.